All right, welcome everybody to Enhancing the Accountant Bookkeeper Connection series featuring Jonathan Carter of CATA Accounting. Hello, I'm Tanya Hiltz, CPB, AIA, and I'm here because I'm passionate about collaboration. And if you're looking for me and don't know where to find me on social, Facebook, Twitter, and Instagram, I'm at Tanya's Bootcamp. I am actually not going to bother going through this slide today. I've decided yesterday because somebody pointed out to me, there were 3 speakers on a webinar I was on. It was 13 minutes before we could dig into the content. A little bit of that was my chatting at the beginning. So I am going to go through and just point out just the top 3, and that's it, of the most important things. But again, I think you guys know me here. So there it is. You can read it if you like. And I didn't change this quote from last month either, but I just love it so much. If everyone is moving forward together, then success takes care of itself. And that was by Henry Ford, founder of the Ford Motor Company. I truly, truly believe this. And this is one thing that really, I found Jonathan and I had a connection with, because Jonathan agrees with this as well. And so we've collaborated a lot together. He is my accountant as well. I know he's the accountant for at least one other person on the call. Yeah, so again, just amazing person to collaborate with. So again, thank you, Jonathan, for doing these. And these were Jonathan's idea, which has morphed into, like, I think it was only a couple, and we're on year 3 now, aren't we? Or 4?
Yeah, we're on year 3.
Okay, year 3.
Yeah.
So, and that's great. So you must be subscribed to receive your recording. So if you don't get the recording and the CPD credits, if it's not received within 48 hours, don't forget to check your spam. Here's the instructions that you'll need to go. Go to bookkeepersbootcamp.ca, click yes, you want to stay in the know, to resubscribe, and then it will actually send you a double verification to verify the email. And then I haven't updated this. I actually get an email when you subscribe so that I can then turn around and resend the recording. So if it's not your spam, you've at some point hit to unsubscribe, and I can't resubscribe you because of the CASA laws. So that's great. So this webinar does qualify for CPD credits through CPB Canada. There will be 2 polls that must both be answered in order to qualify. A recording of the webinar and your CPD credits will be emailed within 2 days. And again, you must be subscribed to receive your recording. If it's not received in 48 hours, go through that process. If you're still not getting it, reach out to me directly. Okay, and we have featuring Jonathan Carter, who's the founder and principal accountant of CATA Accounting Solutions. Again, we've been collaborating with Jonathan and his team for a number of years. Multiple mutual clients, works in QBO, which is where I work solely, so it works great. What I love about Jonathan is his team is a lot of attention to detail, outstanding customer service, and of course, I truly believe that, Jonathan has definitely helped to make me the bookkeeper that I am today with, the year ends. We've got a really good year end process and all of this. And I've learned so much from him, which has made me better at my job, which of course means he's getting the files with all the questions already answered, which is better for him. So, and of course, Jonathan is the type that, or the person that if I'm, afraid to contact the other accountant, I'm probably calling Jonathan first just for a little advice on that. So thank you for being my advice person too, Jonathan.
Absolute pleasure.
All right, so there we go. I'm going to let you take it away. I'm going to stop sharing and let you start sharing.
All right, so today we're doing a repeat that's been updated for 2022. The last time we did this webinar, I believe, was November of 2020. So it's been about 2 years or so. And yeah, I thought this was very useful. I know this was one of the best reviewed webinars we have done together. And yeah, so Tanya, by all means, chime in when you feel like it as we go through the material. So just quickly, yeah, I'm the founder of CATA Accounting Solutions. I've worked with Intuit for a long time in a variety of manners. Very happy to report that my last big beef with Word Papers has been solved. So we're actually at 3 o'clock, we're working on developing a new year-end, a new work paper process for corporate tax using QBO Word Paper entirely. So that's very exciting for me because that's Tanya and I think we've been working on that since like 2019 2019 or 2020 with Intuit on that. So 2018, I did receive the Intuit Inspire Accountant Award. I am Elite Pro Advisor. Our firm is Elite. I am QBO Advanced, as is most of the team, and everybody is working towards that. I was an Insightful Account Top 100 in 2021. I do work with a lot of bookkeeping firms, but we are also like to work with technology companies, and the way we collaborate and we communicate, it really does make a big difference for our customers. So, all right. So just the agenda today. You guys can't see my bar here, right? My share bar and stuff. You can't see. Okay. So why provide a beautiful year-end file? Who are you working with? Some general information that we're going to need, the balance sheet items. We're going to have a little update on the COVID programs, and then some things for income statement items and informational returns, which in Ontario has changed. I'm not going to talk about any of the other provinces or anything in the States because I just don't know enough to talk to those situations. So, first poll question, why provide a beautiful year-end file? A, to look like a superstar to your client and partner accountants. B, because you're legally required to do so. C, to ensure you have proper documentation of transactions. D, to minimize the back and forth with your client and their accountant. Or E, A and D. So we'll just take a moment and get everybody to answer.
Yeah, and just a reminder that you do have to answer both poll questions to receive the CPD credits. You'll still receive the recording if you don't. We're at 60% answering. I'm getting there. Just the last couple. So we'll count down from 5, 4, 3, 2, 1. And the poll and share the results.
Excellent.
5% were A and D.
Yes. So just to address C, to ensure you have proper documentation of transactions, it's a good idea. But as a tax accountant, we're not going into the transactional level. We're not looking at that kind of level of detail. Even in an audit or review, they're going to test, and they're not going to look at everything. They're going to look at some of the things. So that's really on you to make sure you have the proper documentation of transactions, and definitely will make it much easier to create a beautiful year-end file. But it's not something that a tax accountant is going to look at. So why provide it? A beautiful year-end file keeps the costs down. That's a big thing. We've seen a lot of customers come to us who are DIY and they're bookkeeping. There's a lot of back and forth. And of course, the more time it takes, unfortunately, the more we have to bill to the customer. So keeping your costs down will really help. It definitely enhances your relationship and your reputation with both them and the accountants you work for, minimizes the back and forth. Doing it once and doing it right makes your life easier. That's for sure. One thing to be watchful for there is versionitis, and making sure that you are providing the most up-to-date file, the file that actual transactions or changes are based on. And then figure out how it helps you figure out how your accountants want to work with you and with the customer. And you can work together to develop the best way to work together for everyone. So for today, we can't, of course, discuss every possible situation. There will be some time for questions, I hope. So if there's anything we don't cover, by all means, type it in the chat, in the Q&A, or we can address it at the end. So this is one thing that we've noticed a lot is, who are you working with? Are they a CPA or are they a tax preparer? So if they're claiming to be a CPA, you should look them up in their provincial directory, make sure they're in good standing. CPAs who provide service to the public are required to have a registered firm. So you should also look up their registered firm. We have found that we're getting some clients who are coming to us from people who have been working as CPAs, but are either not in good standing. We found one had actually had his credentials revoked for some unethical behavior, things like that. So it's something to keep in mind. Now, tax preparers are very helpful. They have good knowledge, they often have good knowledge and training. Hopefully they are accountable, but not everybody is. If you're going for the lowest price, you're probably getting what you pay for. And there are people who pretend to be CPAs, and we've seen a lot of that coming to us over the past 12 months, where people have been working with somebody who's advertising as a CPA and they really aren't. And unfortunately, CPA Ontario is not very good at enforcing that. So we talked about the registered firm. You definitely want them to be insured and accountable. So our policy is, if a mistake happens and it's our fault, we're going to fix it. And there's not going to be any additional fees. And will they be there when there's a problem? We are. If they're promising results, run for the hills. No accountant should be promising results when it comes to tax. So work with people who you can trust, and trust but verify. So some of the general information we're going to need. Who are the owners? There should be a shareholder register. That is a legal requirement, and that should list who currently owns the company. Who are the directors and officers? There should be registers for these as well, and there should be directors' consents with regards to people who are operating as directors. If there have been changes, there's paperwork that usually has to be filed. Depending on how you're incorporated, it could be different agencies. But these are things that can happen, and these are easy upsell opportunities for you to help people complete this paperwork. Some of the change of directors and officers stuff is so easy. I mean, being able to charge for it almost seems wrong in a way, but we have to be compensated for our time. Are there any related corporations? The ownership of multiple corporations creates tax effects. Not reporting them can be bad. There's one story I have from the past. The person who actually trained me originally on corporate tax, he had a case where a customer had decided to pull his business from his one accountant, spread it out amongst 5 accountants, and not tell everybody that there were any related corporations. Well, of course, CRA knew. They figured it out within 2 years, and they came after him for about $2 million. So it's really important to understand if there are any related corporations and to outline who they are. So there are some key identifiers we're going to need: the business number, legal business name, operating name, and provincial incorporation number. The provincial incorporation number is no longer required on every single tax return, but it's best to provide it because on most it is. So some events, big events that can happen are a change of ownership, change of control of a corporation. That can trigger a short year end. So it's important to understand what is the year end. If there's a change in ownership, then they need to get in touch with the tax accountant to file that stub period right away. And then there's going to be another short year end following that. The major changes and events need to be outlined in the minute book. That would include changes of directors, lawyers, accountants, sale of assets or shares, issuance of shares, dividends. It's a requirement. It's a legal requirement to keep your minute book up to date. And this is one area that we find is probably the most deficient amongst our corporate tax customers. So one thing, please, please, please lock the books before your year-end review and don't make changes after. We have seen a large increase, and some from very, very reputable bookkeeping firms, with changes to prior periods. Some of that is the user on the customer side. Some of that, people just don't know what happened, but it's important to prevent changes from happening. If CRA does review something and you provide them information that doesn't match the tax return, there's going to be more questions and you're going to need to figure out the answers. And it's not a fun situation to be in. So something to keep in mind. Let's go over some balance sheet accounts. Just some basics. Bank accounts, credit cards, and clearing accounts need to be reconciled. The QuickBooks Online reconciliation report takes a snapshot at the point in time. So if you change things, best practice is to redo the final reconciliation so that it all ties together. Otherwise, the information you provide to the accountant with the QBO reconciliation report might differ between what's in the books and what's in what's on the bank statement. So that's something important. We are going to want to see the third-party statement to ensure that the reconciliation has the statement balance on there. And you want to make sure that the bank balance on the reconciliation report ties to the bank statement, and that the register balance on the reconciliation report ties to the balance sheet. When changes happen after the fact, that's where we find the biggest problem, is the register doesn't tie to the balance sheet. And of course, that creates questions and unnecessary back and forth. Also, you need to deal with those transactions that are more than 6 months old. So checks issued more than 6 months ago are stale dated. Hanging transactions are often errors. That can be duplicate sales, duplicate expenses, but check that out. You shouldn't really have hanging transactions kicking around. Usually it's something was entered twice, and this can happen if something is sent through like a Dext or a hub doc multiple times. So that can create a problem. We've also found this with A2X with some of the e-com customers, because it's very easy to double publish something from A2X if you're not careful. Sometimes it's just something was entered, but it didn't happen, and the transaction wasn't fixed, or maybe the amount wasn't changed or something like that. In a perfect world, nothing should be outstanding on the reconciliation report. We know that's not reality. Sometimes there are, especially on credit cards, there's charges that are, they get posted the next month, things like that. Things like that are going to happen. But in general, try to have those reconciliations clean. If there are a lot of uncleared transactions prior to that date, then you need to go back and clean them. So some of the current asset accounts that we look at, receivables, are they appropriately matched? Don't process deposits as sales. We see this all the time, particularly when the amount of the deposit received is not the entire amount of the invoice, because it doesn't make that match. Sometimes we see a QBO is suggesting rules that aren't appropriate, and people are just adding those rules and auto adding stuff. And of course, if you're double counting sales, your customer is going to pay more tax than they need to. In addition to that, their accounts receivable is going to be messed up. So it's something to keep in mind, and try to connect the payment directly to the transaction it relates to. Another issue we've seen a lot more of lately is bad debt. People just think they can write bad debt off whenever they feel like it. There are some requirements. We need to know why it was written off, and we need to have documented collection things. That's not really for us as tax accountants, it's more for CRA when they come back to review. A common instance that can happen of this is the owner issues an invoice, gets paid in cash, pockets the cash, and then tells you to write off the bad debt. So it reduces their sales, and they're essentially taking money out of the corporation illegally. So it's something that it's more common in things like construction. We've seen it a couple times, things like that. But my philosophy is we need to protect our customers, and we will fire a customer if there's repeated issues with accepting cash payment and telling us to write off bad debt. And it's not worth, we can't, as a professional firm, be affiliated with anything that is misleading and that kind of thing. That could really hurt us. So no thanks, see you later. Prepaid expenses, I think we all know what these are. Typically, it's like deposits for utilities, rent, insurance. Sometimes there's software. So like you pay an annual fee and your year end is in the middle of the year. You might need to have a prepaid portion of that. And of course, retainer fees are common for that as well. Best way to outline if your prepaid expenses are correct are to create a schedule, essentially a list saying what is in that account and why it's there. And that will really help your tax accountant. The inventory is another area where we found problems. We are seeing a lot of improvements in this area, but some things to keep in mind is you can't have negative items. So you need to make sure that in order to lock your books, you don't have negative items. Quite often when you make adjustments, you need to make sure they're going to the right place. If they're not set properly, they're going to go to opening balance equity. Generally speaking, there should be nothing in opening balance equity. Another thing that we've seen, and we haven't seen this in a couple of years, so that's good, is does your inventory balance make sense? It's impossible to have negative inventory. So just have a look. And does it make sense? If there's a warehouse full of stuff and it says there's $1,000 of inventory, there's probably a problem. Best way is to keep regular counts of inventory and make sure that you're resolving those problems in real time so you're not crunched in at the year end. And again, if this is something that's valuable, this is a very common area of theft and fraud. People taking stuff out of the corporation and it just showing up as shrinkage. And, this could happen from an owner doing cash sales as well. So, something to keep in mind, something to watch. If the shrinkage is material, if there is a large entry in that area, CRA is likely going to have questions about it, and they're probably going to want to dig deeper. Of course, they base their examinations on recoverability, so it would really depend on the size of the customer. But generally speaking, inventory control is something that we'd like to see done well, and regular counts is the best way to help with that. So, Carol had a client trying to wiggle around self-assessed PST to be remitted for $130,000 equipment purchase. Bye-bye. I'm not sure, but I definitely think there's a story there. Look forward to hearing that one. So, let's talk about the long-term assets for a moment. We have physical assets. It's a good idea to keep a fixed asset register and have the customer check to make sure that they still have all those assets. Now, the way it's kept for accounting purposes and tax purposes is slightly different, but by having that fixed asset register, you can help them determine if stuff goes walking. This is quite common in construction companies again, as people might just grab a drill or something. And I mean, that might not seem like much, but sometimes those things can really add up. Have a policy about what physical assets are set up as fixed assets versus expensed. Generally speaking, $500 or more should be a fixed asset. Under $500 should be an expense of some sort. Small tools is a good category for that if it's something smaller. But depending on the company, you might have a different policy. So it depends on how big they are, what they're trying to show on their statements, things like that. Make sure that the assets they still exist and are functional. That's something that's kind of important. And then there can be a fixed asset continuity schedule showing depreciation. We do that as a matter of course for the Schedule 8 and the CCA claims on the T2 tax return. But it might be something that you want to do as well. It's definitely an added value. The depreciation that you book does not necessarily have to be the same as what's on the tax return. That's how we do it, though, is we tie books to tax as often as possible and as closely as possible. Isn't always perfect, but if it's not, then we need to be able to explain why it's different. Intangible assets, same thing. Create that register, keep the register. It's important for shred claims, and it can be very important for valuing the company. So even though you might have like an intellectual property, like a patent that has a book value of a certain amount, that patent could be considerably more valuable if the customer is looking to sell the company or looking to sell the assets that include that intellectual property. So that's something that's very important, is to keep those separate and keep a register of them. And it's a good idea to have the backup legal documentation for that too. This is definitely somewhere where your customers are going to need more advanced, likely legal advice with regards to intellectual property and protecting that intellectual property. And there are a lot of specialists out there who will help with shred claims. Another question that should be asked is, should assets be impaired? So this could include things like, patents, trademarks, goodwill, and you might want to amortize accordingly depending on the lifetime value of those things, or if you want to tie books to tax, things like that. Loans, if this is on the asset side, so if there's a long-term loan out there, the current portion should be in current assets. The long-term portion, more than a year out, should be in the long-term assets. Make sure that the interest is appropriately allocated to the correct income account and not the loan account. We see that quite often. And keep an up-to-date loan amortization schedule and good documentation about the loan. Quite often we see loans like this that have no documentation to support them. And if CRA finds that, there could definitely create some problems for your customers. So, documentation is key when it comes to that. So best practice, Carol has a question here. Is there a best practice on the dollar value for fixed assets? I get some CPAs like $200 value plus, and others like $500 value plus. We tend to use $500 value plus, but we do have one customer whose policy is 250 plus. And, you know, if you're working with a very large customer, you're probably going to have a higher threshold, maybe 1,000, maybe more, depending on the size of the customer. Now, I think most of our customer bases across this group are not going to be in that situation, but it's something to keep in mind. And it's part of their accounting policies. So let's go up over to current liabilities. Review the accounts payable. We see quite often that things are being processed as bills, and then the payment is going through as an expense. So the bill is hanging there. This of course is double counting of expenses, double claiming of ITCs, something to be very careful about. With our regular bookkeeping customers, we're reviewing this every month with them. And you need to sometimes hold your customers' feet to the fire. And it's something to, oh, I went ahead there by mistake. It's something to, you know, keep in mind and to push them on, because if they just say everything's paid, that doesn't help you at all. You need to know how it was paid. And sometimes there are things that should be written off, like an invoice went in and then there was a a bill went in and there was a revised bill. So the old bill was, you know, somebody forgot to take it out. So it needs to be taken out, things like that. And then of course, do the balances make sense? If it's negative, do you have a credit on account with that vendor? Something to validate and verify. So it's something else to keep in mind. Accrued liabilities are like the opposite of prepaid expenses. These are expenses that should be recognized in the current period, but you haven't got the bill yet. One of the most common is the accounting fee. It could also include legal fees. Lawyers are notoriously bad for issuing invoices on time. Again, create a schedule. What's in the accrued liabilities account? What are the amounts? What do they represent? And why are they there? From the loan side of things, again, the current portion should be in current liabilities. Longer term portion should be in the long-term liabilities. That's not due within the current year. And of course, make sure that the interest is appropriately categorized, keep the up-to-date loan amortization schedule, and make sure the loan is documented. This is an area where we see a lot, where the person has taken a personal loan and there's no documentation indicating that this is related to the corporation. Yet they're trying to book the loan in the corporation and write it off in there. Quite often this relates to vehicles, but we've seen like lines of credit, things like that as well. If there is something like this going on, best practice would be to have the loan tied to the corporation directly. The loan is between the financial institution and the corporation. So that's the most important thing. And then of course, if there is a personal component to it, if the interest is blended, you can't write off that interest. So it's very important to keep business and personal separate when it comes to taking loans for businesses. And, you know, we will see that some people are going to be getting into trouble over SEBA and then taking that money out for personal reasons. So, some more key balance sheet accounts. These are often overlooked and not always well thought out. We have had customers come to us with shareholder loan balances where they owe the company hundreds of thousands of dollars, and TR just hasn't caught up with them yet. Discourage, I'm sure everybody here does, but discourage customers from using the business accounts as a personal bank account. Explain to them that they're paying you to do bookkeeping. They're paying you more than they need to track all these personal expenses. Debit balances can be forced into income. So this year, the corporation will not get the tax deduction, and so that's added tax because they're paying tax on that amount, and the individual is going to be taxed on that amount. Now, it's not true double taxation, but they're essentially getting taxed at the corporate level and the personal level, which is why we use that idea of double taxation. If the company owes the shareholder money, it's less important, but you should document it if it's about a specific thing. So for instance, we had one case recently where there's a sale agreement between two related corporations, and part of the balance is going to be forgivable over a longer term. And that is forgivable to a shareholder because that parent corporation owns the subsidiary corporation. So that's something to keep in mind and to track as well if you feel that's necessary. These, of course, have to be allocated to each individual shareholder appropriately. And this is a very common area of fraud where the shareholder will look at it and be like, that's a business expense, and they'll just go through and they'll try to allocate everything to business expenses. A very common one is legal fees, quite often relating to things like divorces or other things that are personal nature that should never be hitting the company books. Another area that we still see is often deficient is the taxes payable account. So you need to reconcile with what's on record with CRA, and the differences need to be identified and explained. It shouldn't just be a basic true up entry. Unfortunately, the fact of the matter is sometimes it does happen. And again, as the tax accountants, we're not necessarily required to dig in and to analyze what happened and why it's different. At our firm, we do, but of course, if this is not reconciled, it will likely end up in additional fees to the customer. So it's something to avoid by doing it there. Do it once, do it right. Understanding how QBO functions with regards to sales tax can help a lot with this. So sometimes people make direct journal entries to the sales tax account without adding the tax line information correctly. And of course, you know, if it's in a prior period, it could require an amendment. There's all kinds of implications about that. But understand what's going on with your source deductions, your corporate tax, and your sales tax accounts, and make sure they're reconciled regularly. Equity, I'll just be really quick about. There shouldn't really be very many transactions in the equity area unless there was a change. So again, some loans can be converted to equity when certain events happen. That's something to keep an eye on if you're working with startups or people who are getting convertible debt. If there's new shares issued, if there's new fundraising done, those are areas that can affect equity. But generally speaking, you're not going to see very much activity in that section, and it should be reconciled and roll every year. So again, you know, if your retained earnings doesn't match to what was on the tax return at the end of last year, you need to understand why and what happened. And maybe that's a correction. Maybe there's amended HST returns required. There could be all kinds of implications. So understanding the flow of the equity accounts is pretty important. So some COVID programs, we have SUS, the CCRA, CRS, CEBA, and then there's other provincial programs. Everything should be listed separately. That would be, in my mind, the best practice. It should all be listed in the other income section down, what we say, below the line. And then if you are doing tax returns for corporations, or even for individuals, these are considered grants and subsidies by CRA, and you should use the appropriate GIFE for the corporate tax returns. So to be clear, the applications for any of the first three should be booked on as accounts receivable on the last day of the period being covered. So it's accrual basis, not cash basis, okay? The CEBA, you should have a contra account for the forgivable amount. That needs to happen in the year that the funds are received. So if your client received, you know, the 40,000 in 2020, there should be the 10,000 forgivable contra account hitting other income on the 2020 taxes. And then if they got the expansion of 20,000 in 2021, you should show again that 20,000 coming in, an extra 10,000 forgivable, again going to other income. Okay. All right, so let's pop over to the, oh, there's a question here. So an anonymous attendee says the creation of schedule sometimes paralyzes me. Is there some kind of template? So essentially what a schedule is a list. So you're going to list the different entries that are in there, their amounts. The total is going to match to what is in the account, and you're going to just list what they represent and why they're there. So it's not really something you have to fret about too much. It's essentially a list. All right, so some key income accounts. Passive income versus active business income is something that's very important because they're taxed in different ways. So passive income, that could be rental revenue, royalties, licensing fees. There are other things, interest, dividend income. These can all be considered passive income. They need to be in separate accounts, best to have them grouped in separate accounts, and to explain what the nature of those accounts are. If a company, particularly a startup, is earning a lot of passive income, this can be huge to their valuation. Recurring revenue is very important to valuation. So that's why, of course, value pricing or subscription pricing, I guess, is the new catchphrase. These are things that can really help increase the value of your bookkeeping practice. And for your customers, when they're getting that regular passive income, it can really help increase the value of those businesses. Active business income could be product sales or services. Understanding where they're occurring is important because it matters for sales tax. We have talked about the Wayfair decision in other webinars. Ironically, Wayfair is still one of the worst with regards to sales tax, but it's something to keep track of. One thing that you're also probably going to have to keep track of in the future is retail or like physical sales versus online sales, and where those sales are coming from, not only geographically, but are they coming from your e-commerce platform? Or are they coming from your regular business? Again, this is a common area of fraud where a team member may sell a product and pocket the cash. And then, of course, the product isn't in inventory, the account gets done, the shrinkage amount is higher, and somebody has stolen from the company. So that's something else to kind of keep in mind. If the owner operator is serving a single customer, they might not be eligible for the small business deduction. So keep that in mind, especially if you're advising somebody whether or not to incorporate. Probably best to avoid that conversation, but it's something to keep in mind. And of course, time tracking can be very useful to helping the customer understand how their time is being spent and where their money is going from a labor perspective. You might also want to divvy up your labor, for services rendered into different categories and whatnot. So for instance, for us, we have tax income, we have consulting income, we have bookkeeping income as three of the main accounts on our P&L. All right, so next page. Some key expense accounts. Legal, accounting, and professional fees should be all the invoices should be reviewed. Sometimes bookkeeping is in here. Bookkeeping is definitely something that should remain in these accounts, but things that could be structure related sometimes need to be capitalized and amortized. That could be like legal fees around intellectual property. They could be about restructuring the corporation. There could be accounting fees related to that. Sometimes these need to be amortized. Also, be very careful that they are legitimate deductions. We have seen legal fees for divorce proceedings, legal fees for buying a house. We've seen all kinds of different stuff try to get pushed through there by customers. And we scold them on it. And it's kind of like, you get a couple warnings, but then after that, it's like, listen, like if you're going to continue to do this, you're not going to be working with us. Meals and entertainments and gifts. This is probably the most common area is like, oh, I went to lunch. That's meals and entertainment. No, that's you buying your lunch. That's a personal expense. That is not a business expense. Document those transactions. Write the name of who you met with and why on the receipt. We bug customers about this all the time. We have a canned email that goes out to them if we're not getting adequate information and they're insisting it's meals and entertainment, then the risk is on that. You should segregate all your meals transactions, and keep in mind there can be a taxable benefit situation for staff parties if the value is over a certain amount. So if there are like a team party or something and it's quite expensive per person, that's something you might want to consider and counsel your customer about with regards to their budget for those events. I think we did a presentation about that in November. We talked about that a fair bit. So for the gifts, again, you need to document who it's going to. Could be a schedule, could be written directly on the receipt, could be like a delivery receipt if it's flowers or something like that. But one common thing that CRA is onto is, a realtor will go to the LCBO in December 1st and buy $5,000 worth of LCBO gift cards and say it's gifts and then just drink on their company for the rest of the year. That's, of course, is completely inappropriate. CRA is not stupid. They're onto that, and they are probably going to be circling back to review those once we get through all the reviews and stuff related to the COVID programs. Vehicle expenses are another area where we see a lot of playing. Be very clear who owns the vehicle and book or don't book the expenses appropriately. So keep the logbook. It's definitely a good idea. If the vehicle is corporately owned, that logbook might support a taxable benefit to the employee who has access to that vehicle. If the vehicle is owned personally, then you probably shouldn't be running your gas through the business. It should be claimed personally and then charged back using the mileage rate to the corporation. That's CRA's preferred method if you're using a personal vehicle for business, is to use the mileage chargeback rate. So it's something to keep an eye on with regards to how vehicles are handled. Let's see, we have a couple more questions. Oh, no, that one I answered. So there is a rule, and it's, I believe it's 12 hours or overnight. I'm sorry, Carol, I don't recall off the top of my head, but it's important that you segregate those separately with regards to any meals, just so that they are tracked differently, and they're not getting blended in with travel and causing CRA to look through a lot more stuff. You definitely want those segregated. Like say for instance, if I drive an hour and a half, which I would never do, for a client meeting, and then I have the meeting at lunch, that's meals and entertainment, I write it all down, fine, and then I have dinner on the way home. No, that's personal. That is not a business expense. Now, if it's like, say, for instance, I go to Calgary for IPDC Ignite, those meals would be travel expenses. So another thing to kind of keep in mind, just to expand on that a bit, was any of the travel portion personal? Should it all be written off, or should a portion be going to shareholder loan? Those are some questions that you might want to consider as well, to be completely above board. So penalties, interest, and other non-deductible expenses need to be in separate accounts. Pretty much any penalty, interest, or legal settlement with CRA is not tax deductible. Some other things might be ministry fines, like Ministry of Labor, environments, things like that, parking, speeding, tickets. Those things are not deductible. So they need to be classified in different accounts and clearly identified. If they are grouped together, we're not looking at a transactional level. They're going to be taken 100%. If your customer gets reviewed, it's going to be on them. And if it was on your counsel, they're probably going to be upset with you. So keep in mind to separate those out quite a bit. So I'm really excited that QBO Word Papers has improved a lot over the last 6 months. So just some quick Coles notes on this. The notes and uploaded documents can now be seen from people within the same organization on the same QBOA account. So if Tanya and I are working on the same customer, and Tanya's team does everything in their QBOA and their work papers, uploads their documents, makes comments and whatnot, we aren't going to see that when we log on to our work papers in our QBOA account. Now, one thing that can be done is to download the zip file and send the zip file, because that will contain the notes and the uploaded documents. One thing I don't like about this is we can't have back and forth on the comments and the questions and answers directly within QBOA, which is a bit unfortunate, but I understand there's a lot of controversy as to who owns the financial information. Our position is it belongs to the customer, not to the bookkeeper, not to the accountant. It belongs to the customer. And I don't really get why the argument exists, but it does, and that's why they've separated things like this. So groupings and statements, this was the last thing that was really bugging me. If you had accounts that were grouped together, so say you had cost of goods sold, you had 5 accounts. In the heading account, it would give you the negative sum of the 5 accounts. So it really could create unnecessary confusion. That got fixed. I think it was just like 2 weeks ago. I was so excited about it. And we're looking forward to actually using this to try and create some compiled financial statements. The last time I checked, and I haven't checked this it's been probably 6 weeks, There were some challenges with whose logo appears on the compiled financial statements. Working with another bookkeeping firm, their logo was appearing on the compiled financial statements, which of course was not appropriate if we're doing the compiled financial statements. So it's something to watch for. You can't just blindly send this information out. If you are doing something like compiled financial statements, definitely familiarize yourself with the CSRS 4200 standard or take a pass. Something to keep in mind, as people who are not CPAs, you won't be held to the same standard, but it's something to keep in mind. Notice to readers are no more. So if you see notice to reader statements for year ends after December 14th last year, that's not appropriate, and somebody needs to get updated on the new standard. So one thing that is very useful, and we've actually been doing this for a while, is to download the zip file when you're done everything, because this will really help you figure out what happened if the prior period numbers change. It gives you a static report, of course, in Excel that outlines, what exactly your trial balance was when you finish the taxes. So I'm very excited to be working on this. And like I said, we've happened to have it scheduled for 3 o'clock today. I'm very excited for it. And I'll share my feelings with Tanya, and then maybe we can actually start using this more actively. I'm very excited for that.
Now, sorry, I just want to pop in there on that and just ask. So you said that the communication back and forth still doesn't work. Now,
yes,
I was speaking to Mike Ford because Mike and I have a mutual client that we're just coming on with here. And what he said, and I haven't tried it yet because there's a whole bunch of stuff that's got to be done before it's even ready. But what he had said is that if he adds, either I add him to my firm as a team member, or he adds me to his firm as a team member, then we can still see it. And that's kind of been the workaround. But then if that's how we work it, would that not still give access to the notes at that point? Like, with that?
So yes, that should work.
Okay.
That should work. I know when we tried it, you and I tried it personally, I think it was like 3 years ago.
Yeah, it didn't work at that point. That's what Mike told me about it. I said, Mike, we tried it. It didn't work. He says, trust me, I'm doing this now. And I said, all right, we'll give it a try. But I said, it was a while ago that we had tried that.
Yeah. Now it should work. So, but it does annoy the intuitive people when you add people who aren't really team members as your team members in the account. But that's their problem to deal with, if you ask me.
And it's true. And I get it. I as well get it. What I said to them is, why can't I just invite you in the work papers, invite you to that so it shows up on yours? I mean, that to me kind of made perfect sense, but I don't know a lot about programming, so maybe it didn't work that way. But yeah, so hopefully, and I'll be really excited to go in and try to work it. So let me know, because the next one, because we're just getting a bunch of ones finished up to send off. And I know that some of yours are in there. So once you've had the call, let's connect up and let's see if we can go ahead and try it. Like I say, some of this we've already got it done, but it's in the Excel template, but I have no problem doing some copying and pasting to see how the flow works.
Yeah, I mean, this is definitely something to test, but it should work. Like if you're invited to Mike Ford's firm, you should be able to do all the work there. He should be able to see your notes. He should be able to see your attachments, everything like that.
Yeah, exactly. And I have no problem whether I'm on yours, you're on mine, as long as we've got access to the clients that we need. I have no problem with that. So we'll figure that out and we'll report back.
Yep.
Awesome.
Maybe that's a future webinar.
There we go. Exactly.
All right. So Carol has another question. Are CPAs still required to send us bookkeepers the adjusted trial balance and adjusting entries? In the handbook, I don't see anywhere where it indicates that must be done. They bloody well should. Now it depends on how the accountant operates. At our firm, we like to do the entries directly. So the adjusted trial balance and the adjusting entries we pull and send to you are going to come right from QuickBooks Online. Now, companies that use caseware and don't book the adjusting entries will be sending it. But of course, remember, they're starting with a static point of time. So if anything has changed since they started their work, their adjusting entries, the final adjusted trial balance might not match your books. So it's kind of a versionitis issue. with QuickBooks Online and with us doing the entries directly, we've added that because we find that, you know, even though the report is available and easy to pull, most people want to get that communication at the end of the process. So we've added that as a workflow step for our firm. All right, last one. If anybody did this webinar in November 2020, they'll know that this has changed a little bit because there was a duplicate on here. So what is the most important in preparing your year-end file? One, A, to send one complete package. B, to minimize the back and forth between the customer and the accountant. C, to ensure you've done all the tasks you need to. D, all of the above. Or E, A, and C. So give everybody a moment to answer.
And just to let everybody know, I do have a back-to-back. I'm back-to-back all day. So I do have to get off right at 1 o'clock, which would keep us on time. So if there's anything, I mean, I think, Jonathan, you've been able to go through and answer everything as we've been going through.
Yeah,
so
if there's any questions, get them in now.
Yeah, exactly. We got 2 minutes left. Okay, so we've only got 75% participated. So don't forget, both polls must be answered in order to get your CPD. So that's great. We'll count down now. 5, 4, 3, 2, 1, end the poll. Share the results. And Retta says, thanks for another great review session. Always learn something new. And that's awesome, Retta, because that is the goal, is to have you walk away so that you can come to these and maybe it's something you've forgotten, but so that you're walking away with something new every single time. So that there is, you know, coming back, it makes sense because you know you're going to walk away with something new, or again, something you forgot.
Yeah. And if there's any feedback on these, I'd love to hear about them.
Yeah.
Happy to see that most people selected all of the above. I guess most important in having multiple answers is really kind of awkward, but yeah, these are the 3 main reasons to do a beautiful year-end file. All right, just to quickly go on. If you fail to prepare, you're preparing to fail. Just one of my favorite quotes. Some things that make you look bad, some things that make you shine. Do it once, do it right. Reconcile the key accounts, reconcile them all if you can. Review the accounts to make sure the information is accurately reflected, and review the account balances to make sure they make sense. Now, I know Tanya's got to go, but everybody knows how to connect with me if you have any additional questions or concerns. And Tanya, thanks again for a wonderful opportunity.
Oh, thank you, Jonathan, and thank you everybody for coming. We still do it because you guys still come. So yeah, and I'm going to be sending out a new mailer because I've got a newsletter that goes out that'll just be letting everybody on my list know, hey, don't forget to try to come to these. So yeah, that I've just taken a look at the email list, and there's like 4,000 people on there now.
Wow, that's amazing.
So, and I haven't sent one of these. It's just in the website and stuff. So everybody that's coming has been loyal to this for quite some time, and that's great. And it goes out on social, but this will we may end up with some more faces, so, or names. So awesome. Okay, well, thank you, everybody. Have a wonderful week, and I look forward to hearing all the good things, Jonathan, that are coming on Work Papers.
Yep, let's do it.
All right, thanks everybody. Take care. Okay, bye.